do want to spend some time talking about the Tax Cuts and Jobs Act from 2017, because obviously that's going to be a big issue for next year. There has been some conversation in the presidential election politics lately of saying this only benefited the ultra wealthy and that it wasn't a benefit to everyone. In fact, Vice President Harris has been quoted by Bloomberg as saying that she wants to, what was the exact quote, get rid of the whole thing when she talks about the Tax Cuts and Jobs Act. So I do want to spend some time talking about what does that mean. Mr. Bunn, you had mentioned before a statistic about what's the percentage of Americans that their taxes actually declined with the Tax Cuts and Jobs Act?
So there were tax cuts across the board. And if this actually does expire, 62% of American households will see their taxes increase. And on average, across those households, across congressional districts, that's a tax increase of $2,800.
So 62% of Americans, their taxes are going to increase. The conversation about that we're only going to do a tax increase for people of $400,000 and up, interestingly enough, $400,000 and up 4 years ago versus now is almost $500,000 based on inflation that's just occurred in the last 4 years at this point. So a $400,000 4 years ago would be the equivalent of almost $500,000 now on that, but that number hasn't changed on it. It continues to be able to increase. For the qualified business income that Mr. Brabant, you talked about, that's a pretty significant piece of the Tax Cuts and Jobs Act. You're talking about if the whole thing just goes away, as Vice President Harris is calling for, you're talking about a very significant increase in taxes for every small business in America.
Yep, that's 9 in 10 small businesses are pass-throughs, and over 26 million small businesses claim this in 2021, and they're going to be looking at a significant tax increase if it goes away.
Thank you. I've also been very interested in the concept that the richest, the ultra rich, super rich, I've heard all the different terms, are not paying in taxes. I'd love to bring some facts to the conversation on this, actually from the Joint Committee on Taxation, the nonpartisan committee that this committee has to be able to work with to be able to get our nonpartisan facts. Yesterday, they put out a statement yesterday, just as they're looking back. They looked at 2017 tax bill. The first year after that, they've got all the records for it from 2019 now, from that year to be able to look at it. What happened with the ultra rich in 2019? They looked at the top 0.01% of earners. Top 0.01% of earners, that's 16,000 filers in America, the top 16,000 filers in America, and they said their average federal tax rate for 2019 was a 34% tax rate. Now, this seems very different than what we've talked about before, that the Joint Committee on Tax said the top 0.01% have a federal tax rate of 34%. What's left out of this is obviously the conversation saying, well, we're not taxing them on what they on their unearned income, and that now becomes the joint conversation: is are we going to do an income tax? Or are we going to do a tax that's not really an income tax, that's a tax on what you actually just have? We're going to just tax you on that. That seems to be the point of conversation here. But when we talk about the actual rate, joint tax is telling us the uber rich are paying 34% the year after the Tax Cuts and Jobs Act came in. So I'm trying to be able to process through this, and this is a debate that we've got to be able to have, because we've got to be able to get into next year to be able to establish what is a right rate on this. Several of you have mentioned actually the bonus depreciation piece, which is a piece I work on a lot on it. Mr. Bunn, talk to me a little bit about that bonus depreciation and what that means for investment in manufacturing in America.
So among economists, this is the area where there's most agreement that from the Tax Cuts and Jobs Act, this was the biggest impact for investment, biggest bang for the buck. And looking forward, we've done analysis looking at different options for extending the different policies in the Tax Cuts and Jobs Act. And it is the most impactful, it is certainly still a tax cut, but for per dollar of tax cut, you're getting the most bang for the buck on growth. And it limits the amount of time that different businesses have to think about their depreciation schedules and what assets are in what class and when they're able to get their deductions. It's a real simplification and big bang for the buck on growth.
Yeah, one of the things we did by doubling the standard deduction is simplify taxes for just about every American and trying to be able to process through this. Mr. Chairman, one thing I do want to be able to bring up that we haven't talked about here, but we'll talk about a lot next year because I'm going to continually bring it up, is that we have a bipartisan effort dealing with charitable donations. The 2017 tax bill and the changes that we made there did reduce the number of folks that are able to itemize their taxes for nonprofit donations and charitable giving. Chris Coons and I have worked very hard to be able to bring multiple different proposals on the tax piece so that individuals that are non-itemizers can continue to be able to deduct some of what they give for nonprofits. We have 3 safety nets in America. The family is the first safety net. Churches and nonprofits are the second safety net. The third safety net is government. And so whatever we can do to incentivize people to be able to actually support both families and the safety nets of those nonprofits helps all Americans. And I want to put that in the conversation again for next year.
Happy to continue this conversation. Just want to make 2 points to my colleagues. Number one, the business tax break that my colleague from Oklahoma has referred to would have been taken care of in the bipartisan bill that we had with the chairman of the Ways and Means Committee. So again, as with helping large families, which already could have been done today, so could have been the business break my colleague's talking about. I do want to make sure, because we did this briefly, and I don't think my colleague was here when I discussed it earlier, this analysis that the highest earners are somehow paying a 34% tax rate is based on the funny math you get when you ignore, buy, borrow, and die. And that's what we have been talking about this morning with Mr. Lord and others, is that it is possible, essentially, to go out and buy a bunch of properties and just sit on them and borrow against them for your lifestyle. And then when you die, everything's just recycled. And that's what we're concerned about. This is about tax avoidance. I, too, saw that 34% analysis, and I just want my colleagues to understand that analysis is based on junk math. It's based on funny math that you come up with when you ignore, buy, borrow, and die. All right, our next